I'm not sure why. Well, anyways.
Okay.
I'll mute. Call the
All
meeting
right.
to order.
Ready? Go ahead. All set.
All right. Well, thank you very much, Sherry. It is
very welcome.
12:09. We'll call the meeting to order, and we'll start with a roll call attendance.
Mayor Alorza,
Present.
Vice Chairman Lombardi,
Present.
Councilman Igliozzi is absent. Smith Silveria,
Present.
Mr. Costello,
Present.
Mr. Hirsch is absent. Mr. Winkleman is absent. We have 4 present and 3 absent. We have a quorum.
That's great. Thank you. So good afternoon, everyone. I appreciate everyone making time, not just for this commission, but also during this crisis. You know, you've been very responsive and very present. And on behalf of all the residents, I just want to let you know I appreciate your willingness to serve. So let's jump right into the agenda. We'll start off with matter number 1. We'll do the investment performance analysis, and I'll pass it over to Eric to get us going.
Thank you, Mayor. Can everyone hear me okay?
Yes.
Okay. If you turn to page 1 of your book, as usual, we can give you an updated estimate of the performance of the portfolio and the manager's line by line. So this performance was updated, this flash report was updated through Friday of last week, and you can see that the rally that we spoke about at our last meeting has continued. The portfolio has made great strides coming back from where it was at the bottom of the market a couple of months ago. As you can see, we're up nicely since our last meeting, and month to date up 0.5%, so down about 11.5%. Year to date through Friday, I will say that even these numbers are out of date. It's probably up another 2 to 3% as we speak, because there's been a very big rally even since Friday of last week. But that said, the reason the portfolio is behaving the way it is multiple-fold. Even though we have had terrible numbers, just terrible economic numbers, markets have been rallying. This morning, for example, we had another initial jobless claims came out. I'm going to say they're down to 2.1 million in losses. You may recall a few weeks ago there was 6.6 million at the peak per week. It's now pushing 40 million people who have filed initial claims in the last 8 weeks. You may have seen that the unemployment rate, the official rate as of last month's estimate, is up to almost 15%. In fact, it's worse than that because of the way this is measured and some timing issues. It's probably closer to high teens or 20 or so. Some people have fallen out of the labor market. Some people are working part-time for economic reasons, etc. It's terrible. It's just terrible. GDP got updated for the first quarter. That came out this morning. It's now down 5% for the first quarter. The numbers are looking like it will fall in the 30% range in the second quarter, the worst in our history. So the superlatives just go on and on. Now there have, and the markets are seeing this, there have been some green shoots, some signs of life. Many states are reopening to one degree or another. Some are much more aggressive or even careless than other states. But that markets are seeing that. They like that. Housing has, especially new housing, has remained quite strong. That's a very good sign. Activity is picking up noticeably there in the new housing market. Existing homes aren't doing as well because of folks don't want to open their homes during the pandemic. So there's actually a supply shortage on the existing side, but on the new home side, it's actually quite strong. Another thing of interest that I thought I would bring up is that which happened in the last month or two is that there has been a massive amount, and it's affecting your portfolio. There's been a massive amount of corporate debt issuance. Actually, we're ahead of last year's pace, which is amazing. And this has all happened since late March, when the Federal Reserve intervened in markets and announced all of these programs that they're going to embark on. So, gigantic stimulus from the Fed, and the federal government. Has already been about $3 trillion on the federal government. On the fiscal side, there's more coming. By the way, that's in negotiations now. That's going to be another very large stimulus. The states will be getting a very large amount of money out of that. That will be in the hundreds of billions. That's something that the market is seeing, the municipal bond market is seeing. Corporate bond market has been behaving very well. Lately, again, this issuance has been colossal. And what's interesting is that the programs that the Fed has announced, which are in the hundreds of billions in size to intervene in the corporate credit markets, have only just begun. They've only bought less than $2 billion worth of assets. Yet the very fact that they just announced that they're going to do that helped calm those markets and shrink spreads, bring those interest rates down much closer to treasuries than they otherwise were. And the very fact that they announced that they're going to do, and markets believed it, has greatly stabilized markets. And in fact, companies are issuing very large amounts of debt right now, and demand is very strong for that debt. So that's another good sign that markets are seeing. We're also getting good news lately on the virus in terms of new cases, but also you may have noticed that markets have been rallying on days when positive data is being announced by companies in the race for vaccines, for example. You maybe heard about Moderna or Novavax, and there's many others that are announcing this, and it looks like, at least in some moderate quantities, that vaccines may be available in a shorter time frame than markets or experts were predicting in the past. So that is also contributing to the rally. Markets are still very volatile. However, I was talking to the mayor about this. The VIX is still, that's a volatility indicator, is still indicating markets' expectations of say the S&P 500 moving maybe 1.8 to 2% per day on average. So while that volatility has come down a great deal, it was 2 or 3 times higher than that at the peak, it's still quite volatile. In fact, just several days ago, the markets fell about 5% in 2 days when a couple of very well-known managers, David Tepper and Stan Druckenmiller, said that they thought markets were very overvalued. Markets sold off rapidly, but have since recovered strongly. Again, just this week alone, in the last few trading days, markets are up, S&P's up about 3% or so, and small cap and mid cap are soaring, and that's something to point out for the portfolio. As you look down the line, you see that the growth value differential is still enormous. That is, the growth managers, the growth indices are far outperforming value indices, and large cap is outperforming mid and small cap. The numbers are quite wide, and the spread between value and growth is really at historic levels. We've never seen the differences in performance in this year, or recent 2 or 3 years, really, trailing numbers. We've never seen such a wide spread. For example, over the last year, this is through yesterday, large cap growth is up 22.3%. Large cap value is down 4% over that year. Mid growth is up 13.5%. Mid value is down 8%. The same is true for small cap. Small cap growth is up 6.4% over the last year. Small value is down 14.2% over the last year. So these are help you. This spread, this differential in growth versus value is a very big issue in markets in recent months and recent quarters, and you can see it in the portfolio. It helps explain why the value exposures, whether they're passive or active, are underperforming the growth exposures. I would point out that the momentum and quality ETFs that we put in the portfolio last year performing quite well. You see that momentum is that's a large cap factor exposure is only down 1.1% year to date on your report. Quality is down a little more, but still outperforming the S&P 500, for example. So we're seeing these patterns continue, and it probably, in my opinion, while it's been better lately, that may continue in the future. For example, over the last week, small value is up 10% in a week, while large growth is only up 75 basis points, for example. So value's been doing a little bit better very recently, but the long-term trend, year-to-date, last 2 years, 3 years, and so on, has just been a massive outperformance for growth. And there are some, including myself, that think that what the Federal Reserve is doing, suppressing interest rates, may help lead that to continue. And that's something we should cover. Much of this rally, of course, is being driven by the Fed. You will be hearing, it's just starting, you'll be hearing more talk in the news or from managers or the reading that you may do. The Fed is going to probably create some new tools, some new ways to try to achieve their goals, and you may start to hear the term yield curve control or yield curve targeting. And for the first time since World War II, it looks like the Federal Reserve is going to engage, most likely, we don't know for sure yet, but most likely in yield curve control, where they will target the yield at the front end of the curve, maybe a 3-year Treasury or 5-year Treasury, somewhere in that range, where they will commit to keeping that interest rate on those Treasuries at or below their target, whatever they decide on, no matter what. They will print money as much as is necessary and buy those Treasuries as much as is necessary to ensure that interest rates do not go above their target. So this is an attempt to convince markets and the world, the real economy as well, that they are going to do absolutely everything necessary to stabilize the economy and help stabilize the job market and get those unemployment claims and that unemployment rate back down towards something more normal. Remember, we were at all-time lows just a couple of months ago at 3.5%, and again, it looks like it's going to end up being around 20%. So huge volatility, huge spread between value and growth. Massive intervention by both the Congress and the monetary authorities, the central bank, the Federal Reserve, and more of that to come. So I would expect more volatility in the coming weeks and months. I didn't even mention the election. That's going to add some serious volatility for markets as we get closer and closer. Of course, right now markets are focusing on the pandemic and the stimulus that we've been talking about. But I'm afraid we're going to have quite a bit of volatility here still for the coming weeks and months. And I don't think there's any way around that. I do think that on average we'll probably go up, however, over the coming quarters and coming year or two because of the stimulus and the things that we've spoken about, and eventually we will have some therapeutics and vaccines, it looks like. So that's good news, but in the meantime, we have to be prepared for more of the same type of behavior that we have seen in recent weeks and months. So with that said, I'll stop at that point and take any questions that may arise.
Thank you, Eric. And before we jump into the questions, I have a question for Sherry. Sherry, is the raise hand feature functioning?
I don't see it on yours, no.
But for folks who are participating as panelists, usually if you go into participants.
Computer, yep, and they should be able to use the raise hand signal.
Excellent. Okay. So if anyone wants to ask a question or make a comment, please raise your hand, and I'll recognize you. And I'll start with a question for Eric. Eric, can you just explain this a little bit more? This differential between growth versus value. I feel like that's a really important point that I want to understand a little bit better. What does it mean that growth is outperforming value?
Okay, sure, Amir. So it helps to step back and understand the difference between growth and value stocks. Growth stocks tend to be stocks with much higher PE ratios, much higher price-to-book ratios, or price-to-sales ratios. They also tend to have higher expected earnings and revenue growth rates into the future. So you think about tech, for example. Those are growth stocks like Amazon and Microsoft and Apple, although they vary a little bit in Google, biotech stocks or new technologies or new developments. Those tend to be the growth stocks. And so because they are expected to have higher growth in the future, they tend to be rewarded with higher price-to-earnings ratios today, higher price-to-book ratios, higher price-to-cash flows. They don't tend to pay dividends like value stocks. Value stocks, on the other side, tend to be more cyclical stocks, more old economy stocks. Think of energy, think of industrials, think of the banks. For example, they tend to have dividends. They tend to have lower expected earnings growth rates. They tend to have lower price-to-book ratios, lower price-to-earnings ratios, etc. So the world ends up being divided, if you will, between growth and value stocks. And there's some overlap, and people have slightly different definitions, etc. But it turns out that they tend to show different sensitivities and behave differently in different shocks or strong environments or interest rate environments, inflation environments, fiscal environments, etc. They tend to behave differently, and in fact, this time around, this difference is historic. We haven't really witnessed as big a differential in growth versus value stocks really ever, depending on what time period you look at it and how you measure it. Suffice it to say, it's very, very large difference. Now, some of the reason lately is that growth stocks tend to be those that are more, whether it's luck or not, they're just not as affected by the pandemic as value stocks have been. So you think of Amazon, their business is actually up as everybody is staying at home and ordering. You think of things like telemedicine or biotech or other forms of technology where they're just either less affected or even maybe helped by what's happening in the pandemic as everybody shelters in place and acts the way they are under shutdown restrictions or stay-at-home restrictions. Value stocks and cyclical stocks have been especially vulnerable and especially hurt by what's been going on very recently, but even in recent years, they were lagging. Now, they were up. They were just not doing as well. So you think of a manufacturer, you think of a bank who has, you think of maybe some forms of real estate where people can't pay their rents, or the manufacturer has to shut down their plant completely, or you think of maybe food service industry, which has been hurt very bad, or other forms of economic activity like that. And they've been much more affected negatively by this pandemic, but also on a related subject, and I've spoken about it before, growth stocks tend to react more strongly to changes in interest rates than value stocks do. And some of that is just math. The way the math works, because growth stocks are, as their name implies, expected to have a higher growth of earnings in the future, what that means is that more or a larger percentage of their net present value is deeper in the future. And so when rates go down, the value of those earnings goes up more than it does for value stocks. So you can think of it as having, like a long-term bond has a longer duration than a short-term bond, and longer-term bonds prices will go up or down more when interest rates move than a short-term bond. It's a similar, although not perfectly similar, concept with growth and value stocks, where they can be more affected by rates. So in recent years, the Fed has brought rates down. They had lowered rates 3 times back after the fourth quarter of 2018, and growth stocks significantly outperformed value stocks in that environment. And then we come to the pandemic, and it just exacerbated it. So for various sort of financial modeling reasons and macro reasons in recent times from the pandemic, we see that growth stocks have been highly favored by investors, and the environment has either hurt them a lot less or maybe even helped them relative to the value stocks, the more cyclical stocks. And that could continue for a while, given what the Fed has said about what it's going to do with rates and how quickly these companies and these various sectors of the economy can recover if and when we do have much better news on the virus and the pandemic.
Okay, thank you. Any other comments or questions?
Yeah, this is Mike. I have a question. I do not believe that we should be doing anything material now, given the volatility. But I do think at some point in the near future, we need to look at the mix between value and growth and the mix between active and passive investments. It seems that our active stuff is really not doing what it's looking at Robeco specifically now, is not performing as well as we'd like. It represents almost 15% of our assets. There's, cheaper indexes that we could use. Also, our value versus growth tilt has definitely caused underperformance over the last several years. And at some point, I'd like us to at least look at what is going to be an ideal mix going forward. I agree that now is not the time to make any substantive changes, but the value story has been around, the poor performing value story has been around now for quite a long time. Statistically, it's at a level that I don't know that any of us have seen ever. But I just think at some point we really need to justify why we're having this mix that we have, and why we have the commitment to active managers in this type of fund. So more of a statement than a question.
Well, let me ask you, Commissioner. So I hear your point loud and clear, both on the substance of it and the timing of it. When would you suggest is the right time to take up this question?
I think that really falls in Eric's lap in terms of the timing and justification. Maybe it's a conversation that happens over the next couple of meetings, and we target we have something in the future where it's targeted, where once the gap is at a certain level, we look into various alternatives. But I really think it would be a material mistake to make any kind of major change in this particular environment. because as Eric pointed out, the small caps have started to rebound. The value has improved somewhat, but that may just be a short-term thing. We'll see. But Eric, what are your thoughts regarding timing?
Thank you, Mr. Costello. I agree that in this short-term environment, because they're so beaten down, they can come back hugely at any time. Like I said, in the last week, small values up almost 9% in a week, while large cap, growth, for example, is up only 75 basis points. So I wouldn't do it right now, but maybe over the next few months, you could. You may recall this is what I sort of on a tactical basis recommended doing this back in February. But of course, the board made a pretty reasonable decision to try to stick with their long-term strategic asset allocation, especially during the volatility, and that's a good decision to do because timing is sometimes quite difficult. So we could do that. Again, I think a little more growth might be something to consider going forward. Because of what we see the Federal Reserve especially is going to be doing. So we could definitely look into that in coming 2 or 3 meetings, for example. On the passive active point, we have added a lot of passive lately. As a matter of fact, we have about 45% of our portfolio in domestic equity, and 27.5% is now passive, and only just a little more than 17% is active now. We're down to only 3 managers that are active, and they are beating their indexes in recent times. If you look at page 20, you'd see that Robeco mid-cap value is beating the index over the trailing 1 year, over 3 years, over 5 years, over 10 years, and since inception. But again, it's value, like you say. Value is just under both passive and active value is massively underperforming growth in recent times. So there's that, and same with small cap value for Robeco. It's been beating its index for 1, 3, 10, and since inception is just under over 5 years. But the point is there, and I think it's the asset allocation point. With the value growth mix, if we wanted to make a strategic long-term change, or at least an intermediate-term change, you could do that over the coming few meetings, and just modest tilting. Usually, that's what institutional investors do: is they make some tilts and make some adjustments. I think that could be fine if the board chose to go in that direction.
Yeah, I'm one of the new. I guess I'm one of the newest members, but if historically, if we had and obviously hindsight's always perfect, but if we had a 60-40 mix or a 65-35 S&P and call it a Barclays number, I'd be curious as to what those numbers look like relative to the last, 1, 3, and 7 year numbers. And by just having the S&P 500, it certainly simplifies a lot of what we have to do and what we have to look at. And I wouldn't be surprised if we had over this 1, 3, and 7 year period that would have outperformed what we have here. And again, hindsight's perfect, so I'm not being overly critical. I'm just trying to think about going forward. What is the most efficient from a cost perspective, from a resource perspective way of managing these monies going forward?
Yeah, it's a fair point. Again, large S&P 500 is all large cap, so large cap has outperformed mid cap, which has outperformed small cap and international. So all of the action, really since the great financial crisis, the time period you're mentioning, has been large cap Large cap has done by far the best compared to anything else in the whole world, really. That's international too. And because the S&P is dominated by growth, it's a little bit more growth than value, you're having large growth, which has been driving. And as a matter of fact, large growth has outperformed the S&P 500 by a wide margin. So the real story, the real answer is concentrated in the large cap growth sector, and that's what's really been driving the bus, so to speak, for all kinds of portfolios, institutional portfolios, endowments, pensions, families, etc. The real question is, how much large cap growth have you had in recent years? And that will be a very large determinant as to how well you have done both on an absolute and a relative basis.
Okay, so yeah, we should absolutely discuss this and take it up. So let's keep this in mind over the next couple of meetings. I imagine that there's still going to be a lot of volatility in the next month, but 2 meetings from now, let's revisit this and see if the timing is right to tee this up for future meetings. Does that sound good, Michael?
Sure.
Eric, does that sound good and make sense?
Oh yes, I think that's fine.
All right, wonderful. Any other questions or comments on agenda item number 1? All right. If there are none, I'll entertain a motion to accept the investment performance analysis as just delivered. Is there a motion on the table?
So moved. Mike Costello.
Is there a second?
Seconded, Jim Lombardi.
All right. Any discussion on the motion? All those in favor, please say aye.
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 Any opposed? Okay, great. The motion carries and the investment performance analysis is accepted. We'll move on to matter number 2, discussion relative to the Dexstar donation fund and other trust accounts. I'll hand it back to you, Eric.
Thanks, Mayor. If you to look at your other package, which is titled Investment Performance and Manager Review Presentation, and then you see all the lists, Dexstar donation, etc. And if you were to turn to page 1, they're all going to look very similar, of course. You see that the Dexstar Donation Trust is up 1.7% month to date, now down 11% year to date. Again, that's pretty well out of date. That's probably up a few percent since we created this report. Again, owing to the volatility we've been speaking about. But the same discussions that we've had would apply here. We could think about the same thing in the coming meetings with respect to the value growth mix in this portfolio, or these portfolios, I should say, as well. There are no alternatives in here. Some of these portfolios are too small for private equity and or hedge funds, etc. So there's never been any in there. But you see the same discussion would apply to these portfolios.
Any questions for Eric? Okay, if there are no questions or comments, then I'll entertain a motion to approve the investment performance analysis relative to the Dexstar donation fund and other trust accounts. Is there a motion on the table?
I'll make
Mike
that
Costello,
motion,
move
Mayor.
approval. Mike Costello,
Okay,
second.
Commissioner, I'm sorry. So Commissioner Costello, I have you as making the motion. And is there a second?
Seconded, Jim Lombardi.
Commissioner Lombardi, seconded. Any discussion on the motion? All those in favor, please say aye.
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 Any opposed? Okay. The ayes have it. The motion is approved. We'll move on to matter number 3, request to transfer $296,000 from the North Burial Ground Trust Fund to expendable account number 801. So, Larry, is this you, or should I hand it over to Sarah?
Mayor, this is with Ms. Gomez from the Parks Department. She'll make a presentation, and she has a document that she will file with the clerk. And this is part of the annual appropriation for the city.
Okay.
And has that information as well.
Okay. So, Karen, you're on.
Okay, this is the annual ask for the North Burial Ground funds to be transferred to the general funds to for our budget obligation. And I do have a letter that I'm going to send to Sherry that is stating that it is in compliance with the Perpetual Care Trust Fund.
Okay, and any questions or comments for Karen?
No.
Mayor, I have my hand up.
Yes, sir.
This is Jim Lombardi. I just wanted to confirm that it's similar in percentage as prior years.
That is correct. I did the math this morning and it was 6%, but I think that's because the fund went down in the last few months significantly. It would have been more like 5% had this happened a couple of months ago.
And the solicitor's office said that that is appropriate.
Correct.
Thank you.
Okay, the way that we've handled these in the past is that we have that document in front of us, it gets entered into the record, and then after that, we take a motion and we take a vote.
Yes.
Since we don't have the document in front of us right now, I'd like to make this contingent upon that document being submitted to the clerk. So I guess I'm looking for guidance on this from the clerk. So typically that document becomes part of the record.
Yes, it will
How
be.
do we handle this situation in making it part of the record, or in making the motion dependent on us receiving that document?
So you can make the motion on a roll call vote contingent upon getting the letter from Karen and me receiving it in the city clerk's department. That would be fine.
Okay. And the question of it being entered into the record, is that a concern?
Yep, that will be entered into the record, and will be put on the portal right after the meeting, as soon as I get it from Karen.
Okay. So do we need to take a separate vote on entering that letter to the record once it is delivered to us?
No, you can just pass it contingent upon me getting the letter. That's fine, on a roll call vote.
Okay. So I will.
Just want to double check with Penny in the law department. You can do that also, just to make sure that we're doing the right thing. Kenny?
Ken? Who's on from the law department?
Kenny. I don't know. Kenny, can you hear me? I don't know why he can't hear me. I can't hear him.
Yeah, if I may make a suggestion.
Sherry, I'm unmuted now.
Okay.
Yes, Mayor. We have done it previously. The motion can be made contingent to the Parks Department supplying that document, and it will be part of the record. And we have also provided your office with a copy, Mayor, after we've supplied that to the city clerk.
Okay. All right. So let me spell this out then. So is there a motion to approve the transfer of $296,000 from the North Burial account to the expendable account number 801, subject to the letter being forwarded to the City Council Clerk's office and entered into the record as Exhibit A? Is there a motion on the table?
So moved.
I'll make. Seconded.
Commissioner Silvera, and seconded by whom?
Treasurer Lombardi.
Right, Treasurer Lombardi, second. Any discussion on the motion?
Can I have a roll call vote, please?
We'll do a roll call vote, please.
Mayor Elorza?
Aye.
Vice Chairman Lombardi?
Aye.
Councilman Igliozzi is absent. Ms. Silveria?
Aye.
Mr. Costello?
Approve.
Mr. Hirsch is absent. Mr. Winkleman is absent. We have 4 ayes and 3 that are absent. The motion carries.
Okay, great. Thank you, everyone. We'll move on to matter number 4, discussion relative to claims and litigation. Ken, is there anything to discuss here?
No, Your Honor, nothing to report.
So I'll entertain a motion to, I'll entertain a motion to continue matter number 4 until our next meeting. Is there a motion on the table?
So moved.
So moved by Commissioner Costello. Is there a second?
Second.
Seconded by Commissioner Silvera. Any discussion on the motion? All those in favor, please say aye.
Aye.
Any against? Okay, the motion carries and that matter is continued until our next meeting. At this point, I'll entertain a motion to adjourn. Is there a motion?
So moved.
So moved.
So moved by Commissioner Costello and seconded by Commissioner Silvera. All those in favor, please say aye.
Aye.
Any opposed? None opposed. The motion carries. The meeting is adjourned. Thank you so much, everybody. Really appreciate it and look forward to talking